I want to talk about some of the formulas that we talk about in the community. And this is very important. This is going to be review for some of you. I get it. I completely understand. But we want to talk about, and some of this is real basic for some of you, even if you haven't heard me talk about it, right? So, number one is financial formulas and terms is net worth. Everything I own minus everything I owe, that is my net worth. And listen, I just want to be right up front with you. We're not going to include the shoes in your closet, okay? if you if you have to for a little while, okay, I understand. But the reality is we're talking about hard assets, and be very, very um, honest when it comes to automobiles, motorhomes, and boats, because they are a depreciating asset in your driveway that's becoming worth less and less and less. Okay. Um, Income, active income, that can be, when I was talking about active income earlier, talking about you're actively working as an employee in your business. You got a W-2 job, you got 1099 because you're an independent contractor, whatever. That's active income. When I stop working, it stops coming in. Passive income, I mentioned this a moment ago, capital gains from the sale of an asset. That house that I bought for 130 and sold for 260, that's that's passive income. It's just not repetitive. It's appreciation of assets. That could be stocks as well, right? And then passive residual, also known, as I mentioned before, as horizontal income, dividends, rents, royalties. I write a book, it continues to sell, or I write a script, not a script, but a online course. And maybe it's both active and passive. It's active because I'm running that business of the course, but it's also passive because people are watching it or subscribing and possibly joining while I'm sleeping. So that is a PRI, at least a portion of it. So there's the different types of income: active, passive, and PRI. I'm going to keep going with some of these terms. I know I'm going fast. We got a lot to cover, and I want to be respectful of everybody's time. Vitality factor. Okay. This is where you take your personal expenses, and if you have a business and you're running your cell phone and you're running your travel and you're running your medical and all of that through it, you add those back in, because those are and come up with your, what we call your true cost of living before taxes, before charity. That's called the vitality factor. Okay. Horizontal income score, the best measure of your ability over time to convert your net worth into PRI, into passive residual income. And there's a tool that we use in the community that takes and figures out, okay, I've got this much PRI, this much horizontal income that comes in, whether I work for it or not, coming in as a percentage of your net worth. And that's an important thing to measure over time. And maybe you're not there yet, but I'm telling you, if you're not there, you want to set that as a goal, because that PRI, that horizontal income, is what's going to set you free. It's what's going to set you free from ever having to work from anyone ever for anyone ever again. And then we call it the horizontal income score, or a high score. And this is how it's your horizontal income divided by your net worth. That's the formula that you're looking at, which is your horizontal income score. So if I've got 100 grand coming in per year without me working for it, and I got $1 million net worth, my score is a 10. That's my horizontal income score. And by the way, that would be a very good score. Just so you guys know, that's pretty good. I mean, most people are going to end up with a 2 to a 7. If you're in the 10 zone or above, you're elite. You're at the elite level for sure, right? Now, nest egg theory. Freedom is a number. I do not subscribe to the nest egg theory. This is what the common thinker that's not part of this community believes. That means that, oh, if I have $2 million and I have it in a money market account and some stocks and bonds, then I am doing just fine. And I will be able to retire. It's called the nest egg theory. It is wrong. Okay, what does that mean? What do you think the biggest fear of most people that have a couple $1 million or $1 million or $700,000 and they retire? What do you think their biggest fear is? I'll tell you, it's outliving their money, guys. Because if I outlive my money, if I'm getting a 4% return from a stock market investment and a 5% return from a money market account, My blended rate there's 4.5%. So that's what I get to live on per year. If I outlive that money, I've got a problem, and you've got a problem. So I want to encourage you to subscribe to this theory, PRI, horizontal income, passive residual income. That's what we're talking about here. So financial freedom formula is pretty easy, guys. I take my horizontal income and I divide it by that vitality factor, my cost of living. So if it costs me, and I think there's a formula here. If the number is greater than 1.3, you're financially free. This accounts for taxes, the 30% for taxes. So if I've got $100,000 coming in per year, and or let's say 130, let's just do easy math. I got 130,000 coming in as passive residual income or horizontal income, and my bills are 100 grand. That's a 1.3. I'm financially free. I don't need my job. I don't need that side hustle. I don't need any other active income as long as things stay relatively close to what they are today. Okay. Blended tax rate. This is important, guys. You want to, because I'm going to talk about tax drag a little bit too, because tax drag will really work against us if we aren't aware of it. So you've got to be aware of it. The average rate at which you are taxed, and you fix that, on all of your sources of income. You're going to have different categories of income. Many of you are already there. You've got a business income. You've got maybe you're getting a W-2 check because you have to legally from the IRS standpoint. If you're working in your business and you've got a business, you've got to pay yourself what you would pay somebody else to do that same position. So that's going to be a higher tax bracket than, let's say, some other income from other sources. They all come in at different levels. You might have a zero income if you've got a Roth IRA and you're building that up for retirement. So your blended tax rate is taking all of those, blending them together, and you work with your CPA. Ask them, what is my blended tax rate? And if you've only got one source of income, it's easy to figure out. Goal is to have numerous sources of income and have to have some sort of an equation to figure it out, right? Tax drag. I just touched on this a moment ago. That is the wealth draining resistance of taxes on your investments and earning that cost you cash today. See, most people think, well, tax drag, I paid 10 grand in taxes. So that's what he's talking about. Yes. However, if I could invest that 10 grand at an 8% return for the next 30 years, that's tax drag as well because it's robbing you of the future compounded earnings of those lost dollars. It's not just the lost dollars, it's the earning capacity of those lost dollars. Some of you know exactly what I'm talking about. I'm not going to beat a dead horse, but it is very, very important to understand that. So, for the 4 principles to reduce tax drag is structure over deduction. So, number one, you want to make sure that you're paying yourself tax efficiently. This is very, very important. What's that mean? I know that if I talk to my CPA and he's very, very conservative, and he says, well, Rob, a service advisor in your position at an auto repair shop or manager would make $120,000 a year. That's what you have to pay yourself. Or I think there's an IRS rule, no debate, if it's at least 100 grand, right? But I know that I could pay in some states, I could pay a manager 60,000. I'm going to pay myself what I know I could ethically defend. Should I ever have to defend it? I'm not going to pay any more than that. So that's what paying yourself efficiently means. Um, Tax rate arbitrage, probably a little bit too deep for me to go into on this one, but you just want to know what your exit is before you go in. You want to know exactly if I'm going into an investment, I want to know what the exit is. I want to know what the tax implications is because as we know, you've all heard it before, very likely, it isn't what you make, it's what you keep. And a tax strategist on your team is a very, very big part of that, right? You want to invest tax efficiently. Very, very savvy tax planning is the lowest risk way to immediately boost your investment returns. What does that mean? I've heard a lot about depreciation and how it just kicked back into 100%. Well, just know that's not tax free now because if I put in 100 grand into a deal, I get 100 grand of depreciation. That's tax deferred because that 100 grand of depreciation I can use for taxes today, but there's going to be recapture. So it's not going to be gone forever. But knowing when it's coming, if the goal of selling that asset that I depreciated is 5 years from now, I know on year four I need to plan for that. So being organized and being ahead of the game on that is very important. And then in general, long-term growth investments go in your taxable accounts, and ordinary income cash flow investments go in your tax advantage accounts. What is a tax advantage account? It's going to be your Roth, zero tax. It's going to be your 401k, which is tax deferred. Keeping in mind, now I'll pause here for just a moment and just go on a tangent that's not in my notes. It's going to be up to debate who you talk to, whether it should be a Roth, tax free, which is really paying the taxes on the money and then putting in a Roth, and which is already taxed money. Um, Tony Robbins calls it in his book Money Master the Game, paying tax on the seed rather than on the crop. See, because if I put the money into a tax deferred account and I'm 25 years old, well, boy, I'll tell you, by the time I'm 60, I could have earned enough money with that to where that makes sense. I didn't start my tax deferred or um, my tax advantage account until I was later in life in my 40s. So late 30s, I guess. And to be honest with you, it didn't make a whole lot of sense to me to try that runway. I paid the tax on it and I let it compound as quickly as possible because of my advantages in the marketplace. And I can tell you that knowing that when I pull it out the money, that I'll owe no taxes on it is a lot bigger peace of mind to me than wondering what taxes are going to be. I'll ask you, and I know what the answer is going to be. Do we all think taxes are going to be going up or going down? Even if they go up slowly, they're going to go up. It's inevitable because of the deficit the country's in, right? And fixing things, taxes have to increase. So I don't have to worry about that on my tax-free account, but everything should be in my some sort of tax advantage income that's ordinary. Vehicle that's ordinary income. If everybody follows me so far, and I'll open it up for questions at the end. I'm covering a lot of stuff right now, guys. So leverage unrealized gain to compound tax free. Okay, so what is that? Unrealized gains. If I take a business and I buy it for $200,000 and I increase its value to $1 million, that $800,000 deficit or delta is unrealized gains. If I have a stock that increases in value, quadruples, maybe 10x's, if I don't cash it out, it's still unrealized gains. It's not a taxable event. So you want to leverage those unrealized gains. Like I can take that equity in my business that I just used as an example and purchase equipment. I can purchase a new location. I can get a second on my business. Many things I can do to leverage that unrealized gain. And that's what we're talking about here, guys. So again, I know there's a lot going on here, guys, so we'll open it up for questions at the end, and also I'll make myself available to go over this as well. So let's talk about the four principles to reduce tax drag. We just talked about some of this already. We're going to pay with pre-tax dollars. What does that mean? If I got a business, and if you're on this call, you don't have an LLC, please reach out to me. You need to be a part of this community. Everybody should have an LLC because of all the tax advantages that go along with it. One exception might be a state like California where you're paying $800 per year for an entity like that. You might decide to do an S corp, and there's reasons for that beyond what I'm going to explain in this conversation today. But you want to push through an LLC all your legitimate business expenses to your business so you can get an automatic discount before having taxes. Okay. For those of you that don't know what I'm talking about, you need to read Rich Dad, Poor Dad. It's one of the basics, and even Retire Young, Retire Rich, which is also Robert Kiyosaki. I goofed up back then. I didn't know it was a series. Walking through the airport, saw the cover of a book. They always put the bestsellers in the airport. Retire Young, Retire Rich. I was on my way to Vegas, and I said, I want to retire young, retire rich. I read that book in a 3-day trip to Vegas with my wife, changed my life completely. Then I realized it was a series. If you haven't been in the purple pill, Rich Dad, Poor Dad, the cash flow quadrant, retire young, retire rich, and then investing according to Rich Dad, really, really good series, guys. He's got a lot of good books there. They're basic. They don't talk about actual procedure. They talk about concepts. Plan before you play. You really should know planning the tax, what the tax impact is going to be before you make the play. I used to frustrate the heck out of my CPA slash tax strategist because I would make moves very, very quickly and then realize, Rob, you really didn't want to do it that way because of this. And it really was ignorance on my side. But in having him on my team now, we meet regularly. We're due for our next one. We'll meet three more times before the end of the year because I can tell you guys, in December, it's too late to make any changes. Your strategy should be starting to happen in March, and then April, and then May, and then July. And we got probably three more times that we'll meet this year as he says, okay, what does it look like it's going to sell? What does it look like it's not going to sell? All those things come up. And I think it's really, really important that, because again, if I can make a move now to save 20 or 30 or 40 or 50,000, sometimes it's $100,000 moves because of tax planning, because of just making one little tweak or making a decision to own something in a different entity. Or, I'll use a real basic. I used to flip houses, and we would come to the end of the year and I'm excited to sell the house. Somehow muted myself there. Sorry about that. So we would get to the end of the year. I'd be in escrow, and usually you lock in a house for those of us that flip real estate on a single family. It's going to be 30 days. I would start putting it in the contract that I want the sale to happen no sooner, excuse me, than January 2nd. Because, hold on. Because if I sold the house on January 2nd, now we're talking the following year's tax bill, and the following year's tax bill isn't even due until April, which with a tax with an extension is October. I've kicked that tax bill down the road literally almost 2 years, a year and three quarters, just by moving the closing of the escrow 15 days from December 15th to January 2nd. Does that make sense? That's just one really basic. That is the basic of the basics. But I'm talking about going deeper than that because planning the tax impact before you make the play is absolutely critical. Remember, it's not what you make, guys, it's what you keep. We talked about that already, right? And then I've already mentioned it. I've given this next bullet point away. Meet regularly with your tax strategist and keep them in the loop as early as possible. Look, we all have a challenge as entrepreneurs, and that is we're independent thinkers. We're 100% independent thinkers. We don't want to take the time for planning. And I don't know if maybe I'm the only one. I don't think so. But look, this is a visual depiction of what you're doing without proper tax planning. You're trying to run the race with a parachute tied to your back, and it's not going to work. You are going to end up at the end of your career when you have very little runway left for compounding, and you're going to be about half of what you should be. It's that big of a deal. So I just want to encourage you and we're going to talk about it on another slide. One form of income, and it's a big one, is tax strategy. Okay.